Hello Accounting 101 students. In this video, we are going to go over the 3 depreciation methods for fixed assets using the Chapter 9 end of chapter practice exercise question number 6. So in this example, we have a company that had used 3 different methods over time for recording their depreciation. And really, a company should be using the same method consistently year over year. However, for demonstration purposes, we have this company that has 3 different methods. And one of the things that you really want to pay attention to when you're going through a problem like this is which method you are using. You want to pay attention to the date each fixed asset was acquired. And also, once you have the formula, you'll have to figure out what information that you need to use to compute the depreciation for a given year. So we're going to start off with the straight line depreciation method. And for the straight line depreciation, we start off with the depreciable cost. So one of the terms that you want to write down is depreciable cost, which is the cost of a fixed asset minus the salvage value. So for the straight line depreciation, we're going to start off by taking the cost minus salvage value. And we're going to divide that by the useful life. And the useful life is an estimate because, of course, you don't know really how long you'll be able to use an asset for. So you go ahead and you use your best estimate. So the first machine that we have, machine 1, we're going to notice that we're going to take the cost, which is $135,500, minus the salvage value. So after 10 years, we assume that if we were to sell the item or if we were to take it to a scrapyard, we would get $35,500. And then we're going to divide this by 10 years. So I'm going to give you all a moment to do the math here, which ends up being really easy in this particular problem because it's just going to be $10,000. And this is going to be our annual depreciation. But one of the things that you want to consider in your straight line depreciation is that not all of your assets are going to be purchased on January 1st of each year. So you're going to multiply that by the time period. So if you had purchased this asset not on January 1st, but in a different month, you would consider how many months out of the year you have that asset for. So for addressing this question, you're going to have an annual depreciation of $10,000 each year. You purchased this in 2015. So you're going to have $10,000 of depreciation in 2015, 2016, another $10,000, 2017, another $10,000, and 2018, another $10,000. So your total is going to be $40,000 for these years. And that's how you're going to get to the answer choice right here, this $40,000. The next method that we're going to be talking about is the declining balance method. And for the declining balance method, you need to know the declining balance rate. So in this case, we're assuming there is double declining rate. So our rate is going to be computed by taking 1 over the useful life. And because it's a double declining method, we're going to multiply that by 2. So in this example, our rate is going to be 1 over 5. And once we take 1 over 5, that's 20%. We're going to double that, so our rate is going to be 40%. Once we know our rate, we now need to compute the depreciation. for each year. For the declining balance method, our formula takes the book value at the beginning of each year times the rate times the time period. So the book value is going to be the cost minus the accumulated depreciation. So that's another important term. I'm going to include this on the top. The book value equals the cost minus the accumulated depreciation. And you should also note that the book value is referred to as the net book value. And this is the amount that is reported on the balance sheet for equipment or any other fixed asset. So we're going to go ahead and compute the depreciation for each year. So this asset was acquired in 2016. So our 2016 depreciation is going to be computed by taking the cost of $81,500. In the first year, we have no accumulated depreciation, so I'm going to subtract out 0. I'm going to multiply this by our 40% rate. And for this particular asset, we have it for the whole month of July, August, September, October, November, December. So it's 6 months out of 12 months. So you're going to take your calculator and you're going to take 81,500 times 0.4 times 6 divided by 12 to get 16,300. So for the first year, your depreciation expense is 16,300. Your accumulated depreciation is 16,300, and your ending book value is going to be 81,500 minus 16,300. So it's going to be 65,200. And you'll want to know this because the ending book value of 1 year is going to be the beginning book value for the next year. So our 2017 depreciation is going to be computed by taking 65,200. So the ending book value of 1 year is the beginning for the next year, times 40%, times 12 over 12, because we have the asset in place for the whole year. So our depreciation for the second year is going to be 26,080. So that means that our depreciation expense is going to be 26,080. And our accumulated depreciation is going to be 26,080 plus the prior year's accumulated depreciation. So now we need to add both of these together to get our total accumulated depreciation for 2017. So we have 42,380. And the other thing that we want to compute is our 2017 ending book value, which is going to be 81,500 minus our accumulated depreciation. So that will get you 39,120. Now we're ready for our 2018 depreciation. For 2018, remember 1 year's ending book value is the next year's beginning. And we're going to multiply that by the same 40% rate. And this asset will be in place for the whole year. So our depreciation is 15,648. So that means that our depreciation expense is 15,648. Our accumulated depreciation is now going to be computed by taking 15,648 plus our prior year's accumulated depreciation of $42,380. And that's how we get the answer in this problem of 58,028. So that's how we get this machine 2 accumulated depreciation. And of course, if you wanted to know your ending book value for the end of 2018, you're going to take 81,500 minus 58,028. And that will give you the amount that will be reported on the balance sheet, which will be $23,472 for this fixed asset. All right. The last method we're going to be talking about is the units of activity. And this is based on actual usage. So we need to come up with our rate per unit. So our rate per unit, we're going to take the cost minus the salvage value. And remember, this is referred to as the depreciable cost. And we're going to divide that by our total estimated usage over the life of the fixed asset. So in this example, our rate per unit is going to be 77,600 minus 7,600 salvage value. So our cost minus salvage value. So that's going to give us our 70,000. And we're going to take that 70,000, and in the problem, it tells us that the total machine hours is 35,000 hours. So our rate per unit is going to be $2 per unit or per hour. Then we're going to compute our depreciation for each year. So for 2016, we used this unit for 710 hours times 2. So that is 1420. For 2017, we use this for 5,000 hours times 2. So our depreciation is going to be 10,000 because we used it for a longer period of time, so more hours. And then our last one is 6,400 times 2. So we have 12,800, and your accumulated depreciation is going to be all of these added together. So you're going to spend a few moments just doing the math, and your answer is going to be 24,220. So what you'll want to remember is you need to read through the question carefully, because this question gave you the total machine hours, and it told you the actual hours within the problem. And for this particular method, you didn't need to know the useful life. One of the other things that you want to notice is that this method, the depreciation will vary each year, whereas in the straight line method, the annual depreciation will be the same each year. The first year and last year might vary based on the date acquired. And for the declining balance, typically you'll have more depreciation expense in the beginning years and less depreciation expense in the later years. And in the very last year, that's when you're going to consider the salvage value. So I recommend practicing as much as you can. The other part of this problem is going through the depreciation expense for the declining balance, but the only difference is that the time period for the first year is April 1st instead of July 1st. So you'll want to go through the same steps, but just consider the months. Thank you for watching this video.